All right, let's talk about Target earnings. This is one I was very much anticipating. Um, this is one I consider. Let's say Walmart is the Squidward. Target's like the Squilliam Fancy Son, right? This is the more sophisticated cousin of Walmart. Now they don't do quite the business. Obviously, Squidward's the star of the show, but Squilliam, he's a nice little side character, right? I don't know. That's my thought on it, you know. So let's look at this. This was down 2% actually today, nearly 3% from this earnings. One that I was very anticipatory, you know. And some of it might have been, if you think about just the run up that this thing's had, really from its lows. I mean, it shot up another 30%. Year to date, still down, not by too much. But it's had a big run up here in the past couple of years, honestly, since, I mean, even the last year, since 2019, up around 100%. Like, I mean, trust me, I hold this thing, so I know all about it, and wish I had more shares. But let's look at these earnings. Gosh, I don't like that. So, Target beats non-GAAP EPS of 59 cents, beat by 19 cents. GAAP EPS of 56 cents, beats by 10 cents. That's a big beat. That's a very nice beat. And you saw a similar story with Walmart. Even with all the expenses taken into effect, Q2 is going to be harder for them, but even with all the expenses in Q1, with that 1 month where they would have been spending a lot, to keep an EPS beat is nice. And from a revenue perspective, look at that, 19.6 billion, up 11.3% year over year, beat by 580 million. That is a very big beat too. Very big beat for them. And to see an 11% year over year growth is this Target? Is this a retail store, or is this a growth company? I mean, come on now, is this big tech? Whew, got me hot and sweaty, and it was up pre-market. And to find this down today is kind of a shocker. I mean, I don't know why this one, when the market was up and this one got sold. It's kind of weird. I'll be looking to pick up some more shares most likely. Even though my cost basis is so low, it's been hard for me to pick up shares at these values, but I still like the stock. Very good value for it. Comp sales of 10.8% growth versus a 7.5% growth number. Pretty crazy. I mean, that's a big beat. So 12.5% increase in average basket. Fewer but bigger shopping trips, as we expected. Traffic was down. The real big kicker here, which I don't know why, like, this alone should be sending this stock soaring. They're winning online retail. They are. Comp digital sales were up 141% for the quarter. Are you kidding me? The big boy Walmart's posting a 70% number, which is massive. Target's over doubling. You know, that's 2.5 times the business online this quarter. That's insane. Contributed 9.9% points to overall comp sales growth. Just massive growth. Gross margin did fall to 25.1, and you'll see it fall a little bit more. SG&A expense rate actually declined. Interesting. Operating margin slipped. EBITDA decreased 39% to 1 billion as expenses. Red card penetration fell to 22%. Number of stores increased 20 new stores this quarter, or 20 more stores year over year than they had, obviously last year. The company repurchased 5.7 million shares at an average price of 107.58 for a total consideration of 609 million. Due to uncertainty, they're pulling guidance. What a shocker. They didn't give me a presentation, and it makes me kind of upset, Target. I mean, I call you Squilliam Fancy Son, and what do you do for me? You don't give me a presentation. Let's see. First quarter comp sales, we love that. Store comp sales grew 0.9%, and again, they said 9.9% of that was due to digital sales. Son of a gun. That's massive. Digital comp sales accelerated every month in this quarter, from 33% in February to 282% in April. Holy freaking crap. And as places start to reopen in May, you might not see as big of a number as that, but you're going to see a big number. You see the momentum. That is insane. Stores fulfilled nearly 80% of Target's first quarter digital sales. That is crazy. The stores were fulfilling those as opposed to distribution centers. It's really good to see that. And a lot of stores are probably going to be going to that as well. They'll be shipping from their actual stores. Makes it a lot easier. Same-day services such as order pickup, drive up, and shipped grew 278% and accounted for approximately 5 percentage points of the total company comp sales growth. The company saw a healthy market share gain across all 5 of its core merchandising categories. Massive stuff. I mean, what can you say? That's just massive stuff. That makes me super happy about that. I mean, what can I say? Let's look at some of these numbers here real quick. I think it'll go right into the balance sheet, but overall, looking at these numbers, you see it's just massive. So, and they're saying that obviously the results are highly fluid, so they're not going to be giving an outlook, but operating results, the company total comp sales, we saw that operating income was $469 million, which was down 58% year over year. So that is one thing to consider there. Definitely one thing to consider. I would like to know their take-home cash, but let's see. The decrease reflecting the impact and actions taken by the company's merchandising teams, including cost and inventory impairments related to the rapid slowdown in apparel and accessory sales. Not unexpected there by any means. Not many people are shopping clothing right now for the time being. So pretty nice. Dividends of $332 million in the quarter. Pretty nice. Yeah. I mean, we like it. There's a decline in share count year over year. Nice. Yeah. I don't know. I like it. I like what I'm seeing. Let's look at this balance sheet. See if I can still like what I'm seeing. I hope I do. So luckily they give me a year over year. I don't really talk about the quarter over quarter. It doesn't matter. I like quarter over quarter. It's not 3 months isn't much of a metric for me for these companies. Year over year is where I like to look. So right now they have total current assets of $14.6 billion versus $11.6 billion last year. $3 billion more in that. Total assets in general, $44 billion versus $40.6 billion. So big growth in that. $4 billion overall in terms of growth. Total liabilities in general on this company. Let's see. So total shareholder investment or equity right there. They say investment instead of equity. So they've got $11 billion more in terms of assets than they do liabilities. So it's a good number for this company, and they're paying a good dividend on it for sure. Very excited that they're rocking it. I don't know. I mean, this company is doing super well, and I think it's still even a decent buy. A P ratio of 18 right now. You expect the forward PE to be a little bit high right now just due to the increase in expenses you're going to see in the next couple of quarters. But overall, I'm pretty excited with this. I think this is a great company, not only for a nice dividend that will continuously rise, by the way, for years to come, but we're also just going to see just this company's good. I mean, they're a well-run company. As long as they stay out of the freaking politics like they shouldn't be messing with, they're going to be doing well. Very awesome to see Target doing well. I don't know why this stock's down, but I might consider picking up some of these shares, at least some partial. Maybe we'll take a peek, right? All right. Hope you enjoyed.